Hello, everyone. So, I want to address an issue right now which is very important. Remember what I told you? One of my pet peeves is that one thing we need to watch out for is this whole discussion around the national debt. As long as no one is talking about it, I think we should be fine. But then again, this is what happened about 21 hours ago, on Friday. Listen to this discussion.
Economy.
David, one of the things I noticed that we're seeing in this election year, and we still have a ways to go, is both candidates have actions and plans that will accelerate, deficits and debt, whether it's through renewing tax cuts that a lot of Republicans, I understand, and conservatives say is not the same as spending, but at least on paper, the debt goes.
That's right.
Believe, and the Wharton folks, another $5 trillion or more under Donald Trump, another trillion or more under Kamala Harris. But that is one thing that's not being addressed.
That is not being addressed.
What do you think?
That is not being addressed. Keep that in mind, okay? Let's see what this guy says. He's a former World Bank president.
These are huge problems. The government is getting bigger and bigger and bigger. And so whenever it sees a problem, it says, oh, the government is going to be the solution. That's this talk about having the government build housing for people because there's, an affordability problem. I think we really have to look at the importance of private sector, of companies, the whole.
So, let's not get too much into the weeds, but basically, as you could see, in this particular instance, we are having an issue with this, okay? So I want you to think about that for a second, okay? So as long as they don't talk about it, it's not an issue in terms of as far as trading is concerned. Okay, so next we want to see how the economy is doing. And look what's going on with the revised second quarter GDP. Let's take a look at GDP.
Exactly how weak the labor market is getting. Now let's turn towards GDP, a revision to the upside. Second quarter, second peak moves from 2.8 on GDP to 3%, 3%. And just to put a face on that, the last quarter of 23 was 3.4. That's where we're comping to on the strength. Consumption also upgraded rather dramatically, 2.9% versus 2.3. 2.9 also comps the last quarter of 23 when it was 3.3.
So as you could see, the economy, in fact, they revised it higher as far as the growth is concerned. So our GDP is growing just fine, okay? So let's not get too bent out of shape with the economy itself. But obviously, let's see if we could pick apart some of what other people are saying about the economy not being so good after all.
Where are you seeing warnings?
Please tell us.
Well, for one thing, you're talking about earnings for the last quarter, which is in the rearview mirror. It's interesting to me that you're seeing the stock market go up, and yet earnings estimates for the rest of the year have actually started to come down over the course of the past couple of months.
Okay, well, but hold on. We're just talking about estimates, right? He's saying, well, look what's going to happen. First of all, the past was good, but that's the past. Fine. Now he's saying, well, if you look forward, the estimates are on their way down. Okay, but hold on. We're not seeing anything very specific in terms of an actual recession right now, right? He's saying, well, the estimates of earnings, of the company's earnings, are on their way down. That's a bit weak.
And there's been no change from the analysts for 2025. So this has been purely multiple expansion related. And
what he means by that is that essentially for the same amount of earnings, we're willing to spend more money per stock, meaning that, so basically the P ratio is going up faster than the earnings are going up. Basically what the P ratio does is that we are essentially paying, right now the P ratio is around 36 as per Schiller, so we're willing to spend $36 per dollar of earning. He's saying, well, the dollar of earning is not changing that much, but the price is going up, so we are hyping up the expectation of how much we're willing to pay for each dollar of earning.
You mentioned the consumer, and yeah, the consumer is really exceeding expectations. There's no doubt about it. But
Well, hold on. But the consumer is the driving force of the U.S. economy. I know we're having some issue with real estate, but the consumer is where it's at. This country, the USA, is driven by the consumer. We consume more than everyone else in the world. So as long as the consumer is buying and you're keeping him and her happy, you should be good.
we have this wide divide right now that's really incredible because real personal disposable income, after tax income in real terms, is growing 1% over the past year, and your real consumer spending running almost 3% over the past year. So the fallout from that is we're seeing this relentless decline in the personal savings rate. I mean, this time last year, the savings rate was already pretty low at 4.5%.
Okay. He's making the point that essentially, while things are good now, things are on their way down. Okay, I don't disagree that things are on their way down. But let's be careful. We're talking recession here. Nowhere near here right now.
Today it's 2.9. It's only been this low in the past 5% of the time. It's a 1 in 20 event. So I look at the consumer. I know you're.
Okay, now we're picking numbers. You know, there's zillions of data out there. There's zillions of data. And frankly, yeah, you could say that on day one, there was a bird that made a quack somewhere, and then we had a recession. And every time there is a quack, there's a recession. But let's not get not nitpicking in terms of historical data. Let's see what else he has to say.
Saying, but it's really the consumer spending report, I would say, is a low quality report because it's not being generated by real income growth. It's been generated by a continued drawdown of the savings rate to a.
Okay, so basically we're not working, but we're using our cash. We're drawing on our cash in order for us to keep spending. We're using our savings to keep spending.
Historically low levels. And when we talk about the recession, we're seeing recession in real capital spending. The industrial sector is in recession, and the housing market has rolled back in a recession.
Well, hold on. So now he's saying, yeah, we have recession. Yeah, okay, well, with 7% interest rate, you're going to have recession in the real estate. But not everybody's into real estate. Nobody owns a house, right? Nobody's involved in this. So yeah, you have a recession, but you don't have the recession.
And these aren't the biggest components of GDP. Of course, that's the consumer. But
okay, as he just said, these are not the biggest consumer. These are the biggest component of the GDP. At least he's honest. It's a consumer. So you may hear, oh, recession in real estate. That's it. It's all over. No. It's not the biggest impact of the GDP. In fact, I just showed you GDP is actually higher than we thought.
There are segments of the economy that are operating below the zero line. Admittedly, not the consumer ... Not yet. As for your
again, he's saying, okay, I have to be honest. I'm not gonna lie to you. I realize the consumer is everything, but there's other things or things are not doing that well.
comment on the unemployment rate, you know, it's not stable at all. It's gone up 80 basis points in the past year, and that's what's caught the eye of Jay Powell. That's the only reason why they're cutting interest rates is they're concerned now that there's too much slack being built up in the jobs market.
Well, hold on. They're cutting interest rates because they want to fight inflation. So now, obviously, like I said before, a big topic is you want the Fed to lower rates, which is great because it managed the inflation, right? So you don't want to have too much. You don't want the. I mean, the inflation is coming down, so there's no need to keep rates that high. You're doing your job, but obviously you also lower rates to fight inflation. So now he's saying the reason they're doing it is because they think there's going to be inflation. Not so much that they beat the inflation, but they think that the recession. I'm not so sure about that's a reason why the Fed is lowering rates. I mean, let's see how much they go down. But if they do 25 bips, which is, I think, that's the only thing they should do, then we should be fine. Of course, these guys, they want 100 basis points. You could say, you see, the Fed is also concerned with it. But so that I could explain to what's going on, and by the way, don't forget to subscribe and to like this video. What I'm trying to explain to you here is that you have to really parse that information that is provided to you as a consumer, right? As an investor. This guy is basically saying what's going to happen is that we are in a recession. We're in a recession over here in the real estate, maybe in the capital goods. We're not really in recession with the consumer, which is the big chunk of the economy, right? Once the recession, once the consumer is in recession, then we're in trouble. But until such time, no. So he's saying, well, we have this and that. And by the way, as you could see, the Fed is also going to reduce the rates because they also know there is a recession. How do you know that? They're reducing the rates because they have beat up inflation enough. Inflation is on its way down. That's the reason they're doing it. And we'll see how much they go back, how much they actually lower. Okay, let's not get too carried away here.
So that's the story, is that you're not seeing job loss, but the unemployment rate is going up, and Powell's already told us.
We are not seeing job loss. Be careful. But the unemployment rate is going up. What he's saying is that we have high unemployment, but we don't have job loss. At least he's honest. What's going on is that we have more people coming into the job world, and mostly through immigration. So you have more people that are looking for jobs. So therefore, it raises the unemployment rate. But it's not because you lost jobs. We don't have any losses of jobs.
That is the most important statistic for him right now.
So, David, do you think that the Fed is behind the curve on this, or do you think that this was unavoidable? Just a two-pronged answer. And do you think that the recession, whether we're in one now or there's one that's coming, do you think that it's a first quarter next year issue or a fourth quarter this year?
Whoa. Please, again, like I've said in my previous videos, and I'm always saying, tell us what's going to happen. We need a prediction. We need to know what's going to happen. Please tell us what happens next. Be very careful in these type of situations because no one knows what's going to happen. Of course, what we need to worry about is not so much what's actually happening, but the perception of what people think is happening. So obviously, if you put people like this all the time on, you're going to start to worry, hey, maybe I'm in a recession. Maybe I should get out.
Well, it's a no-brainer that the Fed's behind the curve, and the yield curve. Speaking of curves, I've been telling you that for quite a while. But Jay Powell.
Wait. The yield curve, we've been told for like 2 years that the yield curve is inverted, and that means we're going to have a recession. That didn't happen. In fact, the yield curve is less inverted now than it was in the past.
Powell told us that both at the last press conference after the July meeting, and then last week at Jackson Hole, when he's talking about how the economy is normalized. Inflation has normalized to a very large extent, and the labor market is not just normalized, but there's more slack in the labor market now than it was before COVID. So is he behind the curve? Well, everything is normal except the Fed funds rate. And the Fed's own admission in terms of where its guesstimate of where neutral is 2.75%. That is the normal interest rate for normalized economy. And the normalized economy is what the Fed's talking about. And they've got the funds rate at 5 3/8%. So recession or not, of course they're behind the curve.
I mean, he's essentially saying that because of where the Fed should be, they're just not able to catch up. Basically, they are acting as if there is a recession. They are acting as if they need to do something where technically they shouldn't do anything there, therefore.
Hey, David, it's Tim. Thanks for joining us. I guess I share that view. And I share your view, at least, that recession-proof, your term, sectors are places at least to be thinking about. It's fascinating that it's a year where you've had a bit of a barbell already. I mean, there certainly has been a very defensive play to the market if you look at what's been going on with gold, what's been going on with healthcare, certainly what's going on with utilities.
Well, hold on. Yeah. So basically what they're saying is that, well, gold has been going up, so we got a problem. Well, gold is going up because of inflation. Okay. So whenever there's inflation, gold goes up, or when there's also concern, major concern, gold goes up. But frankly, I mean, you have to really understand what gold's all about. The issue with these type of discussion, obviously, is that they're basically treating you as if you don't have a vision, and therefore, instead of explaining, they're telling you. They're telling, like, for example, when he says, well, unemployment went up, but we didn't have anyone was fired. Well, hold on. So no one is getting fired, okay? No one loses their job, but unemployment goes up. Well, you should at least say that the reason why unemployment goes up is because we have more people working, trying to find a job, and they can't find it. But that's different. So you got to be intellectually honest.
How do you characterize what you do from here on out? Because based upon the moves we've had in some of those defensive spaces, that's telling you, it certainly is a read on some of the things you're thinking. Have we missed the move in some of these sectors that are not terribly cheap at this point?
Well, of course, what happens in those defensive sectors is that they get re-rated when investors start to see the economy cooling off. And the economy is cooling off. It's not in recession right now, and I think
okay, he said it right. So let's be careful, because when we say indicators, recession indicators are flashing, right? That's bait, right? He's just saying we're not in a recession.
Consensus is that it's not going to go into recession, but we have the supply side of the economy expanding over 4%, and GDP, which is what we all focus on.
The supply side, meaning, they're expecting you to buy stuff.
Let's assume it's running at 2.5 to 3. That's what I'm talking about, is we're building up disinflationary slack in the economy. So I think what's happening here is that interest rates...
Look at the gross domestic product, by the way. Okay. 2.95. Okay, first year wasn't that good. But look, does this look like a recession to you? I mean, last year you could have said this was a recession, and look what happened in the first quarter. 4.81, 3.4, 2.4, 2.95. Come on.
Have been coming down. The Fed hasn't cut yet, but market rate, and they will continue to come down. So I would say that certainly the rate-sensitive sectors in this environment get re-rated with a higher multiple, and I expect that that's going to continue.
So basically, the one that are more sensitive to, in case there is a slowdown, people start buying, therefore the P goes up and the opportunity is lost. Well, you got to be careful, right? Because defensive is one thing, but these are very, very slow growth companies. If there is no recession and you're out there loading up on, defensive stocks, things like Walmart or whatever, although Walmart has been doing quite well, recession proof, those things that you're going to need, meaning food, packaging and things like that. If you're going to load up on these type of stocks and you don't have a recession, then you're overpaying for something that, frankly, on top of that, that's not growing. So you're missing out the boat on everything else. Like people are getting out of, there's maybe not Nvidia, although there's still growth going. Let's talk about Nvidia after, but things could get much better.
And what I call the bonds and drag, you mentioned utilities, which of course has defensive growth characteristics too. Bonds and drag in the stock market, so whether you're talking REITs or telecom services.
So now you're going to go in utilities. You're going to invest in utilities when you don't have a recession and when you have AI exploding.
Utilities, yes, I think that they're very appropriate right now and being re-rated appropriately because of the interest rate outlook.
Next, we need to listen and hear about my colleague over at my academic colleague, Jeremy Siegel over at Wharton. And let's see what he says about the PC and the inflation data.
I mean, bottom line on this PCE data, are we definitely going to see a rate cut? And is it almost certainly going to be 25 basis points?
Well, I think whether it's 25 or more, really, as you mentioned, depends on what we see next Friday. And there's even, some more reports coming before that, September 18th. So, it's definitely going to be a cut. I think it's open between 25 and 50. I think it was really interesting, Wilfred, you mentioning about what's going on in the Eurozone.
So basically, in this case, he's at 25 to 50. Now, I know it looks a little weird, the 25, 50, 100, who cares? Well, it's important because if the market gets the impression that we are cutting rates because there's a concern about the economy and the recession, then all bets are off, right? But if we're just cutting rates, which my dear friend Jeremy seems to imply, at a 25 to 50 basis points, which is basically, listen, I don't need to keep rates that high because inflation is under control. Okay, I don't need to kill any kind of recession because we don't have this issue. I just want to innovate everything in order for us to be able to manage this inflation, which is under control.
Lower, they have a different method of computing the housing. And I've, been on the Fed for so long saying their housing measure is lagged so much that it keeps on feeding in, even though, we have rental prices that have stabilized. They don't have that problem in Europe. And that's one reason I think it's further down. When I actually put...
the thing that they talk about Europe is because Europe has started to already lower their rates. And that's what's going on at this juncture.
On the ground housing prices, and I actually get 2% or even below on year-over-year inflation. I think the Fed is there, and I think to stay at 5.33. Well, they are going to go down, but my feeling is they should move much faster towards what they say is the neutral rate. Now, in that June meeting, they say it was 2.8%. We're going to get a new read, new dot plot.
So he's not talking about there's a recession happening here, right? He's basically saying, I think there's no need for you to keep it that much higher, because then you're going to put us in a recession. I would agree. If you keep rates up too long, right? Remember what happened in 1980s with Paul Volcker. He literally killed the economy. But you had to be careful because he did in the 80s where he lowered rates and then he stopped. And then he started lowering, he raised rates and then the economy went into recession, but then inflation got under control. Then he started lowering the rates, but then he lowered the rates too much and then we went back into inflation again. So we have to be very delicate. Obviously, what does it have to do with trading? But this is important because if you listen to them and you believe in a recession and you get out and there is no recession, you miss the boat. If you stay in and there is a recession, oops, you're in trouble. So you need to really understand what's going on here.
In 2.5 weeks, it may go up to 3, but that's still over 200 basis points lower than where it is today.
Are you saying that, Professor Siegel, because you think, in fact, the inflation numbers give it the room to do so they may as well do so? Or is it because the economy is also weakening at a faster pace than...
Aha! So see the thing that I've been telling you about? Is it the inflation that we need to focus on, or is it the recession?
Then they're perhaps appreciating.
Well, I am worried. Certainly, I got worried with the last...
No, he's not answering. Report,
and it looked like those claims were heading way up. I get worried when they go above 240. Now they've stabilized down on 230. We shouldn't get too excited. We saw that 3% print. But that was April, May, June. We're, just on the verge of September. I was a little disturbed, for instance, the trade report yesterday didn't get a lot of,
Again, we're not answering the question. We're going around the party, and he's not saying I'm concerned and there's a recession.
Yes, because it was, overtaken by everything else. But the Fed, the Atlanta Fed, and several others are going to come out with a report later today. Believe it or not, I think this quarter might have a one handle on GDP. So, yeah, now that's not recession, and I'm not saying recession.
So he's got to be extremely careful, okay, because he knows very well that while in the past we've had recessions, right, driven by extremely high rates, the government has reduced it accordingly. The Fed has reducing accordingly. We are coming out of a situation with COVID, which was a bit different. The reason why we raised the rates and why we went in kind of a very short recession is because not so much because people weren't working, but because we were not allowed to work. So there's a pumped up demand. People want to go back to work, right? Now, of course, they put too much money out there, too much cash, too much money was thrown into the economy, which caused obviously the inflation. But right now, everyone looks at it very carefully, and there's, the GDP has been revised up. Unemployment is going up because of the workforce, but there's no indication right now.
But it is a slowdown.
Yes, it's a slowdown, but that's a different from a recession.
And I think that, given that slowdown, given that the unemployment rate rose to 4.3%, that is above the Fed's long-term target, given we were within 0.5% on their own measure of their inflation target. My feeling is they should be closer to what they say is the neutral rate rather than tiptoe down, quarter point here and there. We'll get there eventually.
Well, the thing is, the Fed does not want to say he has 100 basis point cut, because then people are going to panic and say, oh, they think that there is a recession. You see how very, very, very extremely tight this thing is being run, right? Because what's going to flip us over the side? Or you're going to say, well, when we have a recession, but you will not know you have a recession until a year after. Okay, nobody tells you there's a recession today. The number is going to come out and they're going to think that we're in a recession. So right now it's not. The point is that as an investor, you need to make sure that you have a read. You need to read what the market is doing. That is the most important. Don't try to have people tell you what's happening. You read it, you're understanding, and then you decide where you think we're going. But at least you need to understand what the positioning is and what it is that's actually happening in terms of not what really happening, but what's really happening in terms of the investor sentiment. Right? Are we all out there saying recession, or are we all out there saying we beat inflation and soft landing?
Why take that risk? Be bolder. They were 75 basis points on the way up. For sure, right. They were way too late, and I'm not saying they should panic, but, lower, I think, is the better
Although,
option.
Jeremy, you got a lot of attention not that long ago when you were on our air talking for an emergency rate cut, right?
Yeah,
Everybody's like, oh, my God, what? And you do.
Yeah, we basically says, oh my God, do something, cut the rate. He's no skin in the game. But the point is that he basically said, you got to cut the rate now because otherwise we're going to be trouble. This is too high for too long. That's not what has happened.
You seem to have backed off a bit from that. What was it you were seeing then that you maybe aren't seeing now?
Well, what I did see was that labor market and as I said, the claims report going.
Basically, he was wrong. That's what they're saying. He was wrong. So what happened?
Considerably up. And I said, uh-oh. I saw the Psalms rule being triggered. I saw a number of other rules being triggered. And then I said to myself, well, why is the Fed at 5.3 when they say, it should be at 2.8?
Okay, the bottom line is there's no recession with this guy. Okay. The other one, there is a recession, but for the housing. We're just trying to create some, and obviously CNBC also does a job in terms of, well, let's talk about recession. People want to hear about a recession, right? They don't want to hear about everything is fine. Otherwise, they want to create some viewership as well. So let's keep that in mind.